Are you sick and tired of seeing the stock market red? Is your portfolio bleeding every single day? Do you just not know where to invest anymore? Well, welcome to my YouTube channel where I keep you updated on everything related to the stock and crypto market, and we'll answer all those questions, so make sure you watch this video till the end. Alright guys, we have a lot to cover so let's go ahead and dive right into it. But before we start, if you guys like crypto and like money and like stocks, make sure to hit that subscribe. And I know you guys all like money, so hit the subscribe and smash that like button and join my Discord down below where we do a lot of challenges and keep you guys updated rapid fast. So let's go ahead and dive right on into it. Welcome back, everybody. I hope you enjoyed that intro. So we have webull opened up here right now. You could get 2 free stocks, as I said, valued all the way up to $18.50. That is phenomenal, guys. Free money right here, so make sure you guys check that out. So I actually just wanted to cover, once again, the stock market and what is kind of going on with that whole scenario. So if you guys have not already been updated and watched all my videos, all the way since the beginning till now, make sure you guys go do that. Binge watch that instead of watching Netflix today. So for you guys who don't know, obviously the stock market is dipping because of the bond yields. And for you guys who don't know what the heck that even means, just make sure to go watch my video because I open up your knowledge to what that actually means. So first of all, I wanted to touch up on, obviously this is the bond yield chart once again. And I know I kind of just sound repetitive, like, okay, bond yields, we get it. But I just want to show you this really quickly because it is kind of important. Like a lot of stuff that I'm going to be discussing today because it is going to be action-packed, let me tell you. So first of all, I just want to say that, remember back in March, what happened? You guys can see the article right here. Federal Reserve cuts rates to 0 and launches massive $700 billion quantitative ease program. So this was all the way back in March 15, 2020. If you guys remember, that's when the stock market crashed. That's when we had that huge plummet to the downside. It was insanely bad. Okay, so that basically was when the Federal Reserve made 0 interest rate or had that 0 interest rate. Well, you can't just have a 0 interest rate. What do I mean? Guys, relax. All right, what do I mean? Seriously, what do I mean? Well, you can't just be like, yeah, I'm going to have a 0 interest rate, no more interest rate. All right, no interest for you, no interest for you, no interest for you. You're like Oprah Winfrey. You can't just have 0 interest rate. So how do they get to 0 interest rate? Well, in order for them to get 0 interest rate, they go to this bond yields. Okay, they go to the bond yields. What do I mean they go to the bond yields? They just go to the bond yields and buy all the bond yields. Okay, they go to the bond yields and buy up all the bond yields. Basically, they buy up all the short-term bond yields. So 1 month, 2 month, 3 month, 6 months, 1 year, 2 year, they buy up all the short-term bond yields. Because what happens is if you buy up all the short-term bond yields, the demand goes up because obviously there's a lot of people buying, so the interest goes down. Okay? Likewise, if you don't buy the bond yields, the demand goes down, the interest goes up, and that's exactly what's happening. So that's how they got the interest to go to 0. That basically correlates with the economy. So when the economy is going down, because obviously we had COVID, so it shut down everything, the economy was going down. So what happened was the bond yields were getting bought up, interest was going down, the stock market had that dip and then started to go up exponentially fast. What started now is that the economy is recovering. When the economy recovers, the stock market's like, damn, we're about to see inflation, so it starts going down because the stock market's forward thinking, guys. The stock market has some forward thinking, so if it sees the economy's down and then we have a lot to recover, it's gonna boom. If we see that we're recovered and like, damn, we are gonna have a huge amount of inflation, it's gonna go down. So basically the point that I'm trying to get at is 0 interest was because all these bonds were getting bought up. Okay, what's going on now is that the economy has recovered. The Fed is no longer buying up the bonds. So what's happening is that these long-term bonds aren't getting bought up. So what does that mean? Low demand, high supply, this interest rate is getting increased to start attracting people to buy it. So that's why you see, as you can see, back in 1/4/2021, This 30-year was 1.6. You go down, you could slowly see it's increasing, it's increasing, it's increasing, it's increasing. Now it's 2.28. So you see there's a lower demand because the economy's finally recovering. There's a higher interest. So the stock market's like, whoa! That means we are starting to recover, which means there's going to be inflation soon, which means sell everything, dump everything. We're done. We're done with the stock market. Shut it all down. So everybody's dumping everything. And that's why there's such a big dip in the stock market. Okay. So that's why I want to show another thing. There is even more fear in the stock market. One, because everybody's not buying bonds and the interest rate is flying. And number two is that last year, because of the whole crash, banks were now allowed to not hold as much money inside them. So I know that doesn't make sense at all, but Federal Reserve temporarily eases some bank leverage requirements. And this is going to expire March 31st, 2021. Okay. What does that mean is that before, banks had to actually keep a certain amount of money in there to be able to like manage everything. But because of that whole crash, now banks were able to lend out and go buy stuff and keep a minimal amount of money in the reserve, right? So now what's happening on March 31st, when that expires, the banks have to sell everything to bring all that money back in to have that value inside the bank, okay? So that's the second reason why everybody's dumping everything. So the point I'm trying to get at is, what do you do now? Do you just sit there and get screwed over, or are you going to do something about it? Well, let me tell you, I know I'm going to do something about it because I don't like seeing my portfolio just plummet to the depths of Earth's core. Okay, so this is what happens. Every single time we see a market crash, guys, there is always a shift from high growth sectors to stable companies. What is a stable company? Apple, Microsoft, Amazon, because these aren't going anywhere. I bet you half of you have Apple phones or Apple products, and they shift from high growth, very risky companies like, for example, Tesla. Okay, so that's what I'm looking to get into, and even stuff that hasn't recovered from last time. So airlines still haven't recovered, and if the economy actually opens up, then you're going to see a lot of people zoom. You're going to see a lot of people fly. So a lot of people are going to start taking trips. So what happens is, if a lot of people take trips, airlines are going to start recovering. They're going to make more revenue. They're going to start increasing their employment, and they're going to just increase the stock price. So that's why I'm going to hopefully start shifting into airlines. Why? Because airlines haven't recovered. Shift into from high growth into stable, such as shifting from, example, Tesla into Apple. Why? Because Apple is like a very stable company, or Disney, or Microsoft, blah blah blah. So I hope that gave you guys some insight. I hope that made sense. If it didn't, leave me a comment down below. I'll answer it right away. I hope you guys found this video educational. Smash that like button, join my Discord, and I'll see you guys all later.